everybody, I'm Robert Donovan. Welcome to this episode of Tradecraft Solutions. What price would you put on your individual economic freedom? If you're in debt, I can tell you exactly the price you've placed on at least part of it, because to the extent you're required to pay interest to a banker rather than to do what you choose with that money, you serve the bank. Know that, understand it, and don't forget it. If you've ever paid off a credit card, you know what it feels like to regain at least some part of your economic freedom, however briefly, often before going right back into more debt. Paying off debt means money that went to debt payments is yours to do with as you choose, and with that comes lower stress and a greater feeling of well-being. This is the dopamine hit I spoke of in earlier videos that comes from not having to work your ass off quite so hard to make bankers, landlords, and merchants rich. If you can't remember the last time you paid off a credit card, this series is for you. In this video, I'm going to list 9 ways that banks make it harder for you to get free of them. Some of them will be familiar, some of them not so much. The rest of this series will cover specific debt payoff strategies. This example assumes a $150,000 loan, 8% annual percentage rate interest rate, and a 30-day billing cycle with a monthly payment of $1,100.65, which I'm just going to call $1,100. I've put the formulas for all of the calculations in the description below so we can avoid cluttering up the presentation with a lot of math. You'll see the numbers flashing on the screen and fading in and out as we go. Number 1. You always pay fees and interest before principal every month. We all know the frustration of seeing our balance due barely go down when we send in our payments each month. The reason that happens is that most of your monthly payment goes to interest in the early part of a loan, leaving only the tiny amount for principal. Anything that reduces principal faster reduces your interest costs and pays the loan off sooner. Anything that slows it down makes the bank more money in interest and makes it take longer to pay the loan off. You want to be doing things the first way. Number 2. Interest is compounded before your payment is applied each month. For our $150,000 loan example, the day your first payment is due, you would owe $150,000 plus the monthly interest cost, not just the $150,000. Your monthly payment is then subtracted from this total, and it, in this case, reduces it by a measly $114.33. Number 3. Mortgages compound the full monthly interest cost every month, even if you pay early. Whether they are received early or by the last day of the grace period, mortgage payments get charged the full interest for the entire billing period that month. There is no advantage to paying a mortgage early. The only way to reduce interest on a mortgage is to make extra principal payments along with your regular payment each month. A lot of people labor under the fallacy that paying early helps. It doesn't with a mortgage. What it does help on is number 4. Credit cards compound interest daily, but they charge monthly. Unlike mortgages, credit cards are high-interest, short-term, unsecured loans, and therefore banks have to gouge you a different way. By compounding daily and billing monthly, credit card lenders are able to pocket extra daily interest. However, credit card lenders will allow early extra payments between billing dates. This means that paying early can significantly reduce the interest costs with credit cards. Check your statement to see what the rules are, and always know those rules for when payments are applied and when the interest gets compounded. That goes for any loan. Number 5. Applying extra payments to your next payment rather than to principal. Okay, if you send in an extra payment on a loan one month, do not assume that your bank will automatically apply that extra payment to principal. Some banks do, many banks do not. Some lenders will apply it to your next payment unless you tell them to put it toward principal. So check your statements again. Call the lender or servicer to be sure if you can't track that information down. Car loans are notorious for this because they often require principal payments to be separate payments from your regular payment each month. Number 6. Fees and penalties get paid even before interest. Your most common fee is going to be a late fee, usually 4 to 5% of the monthly payment. Again, you want to check your statement for a list of fees and how they're calculated. Fees get subtracted from your payment before interest or principal is paid. So let's say on our example loan, our first payment was late, which would not be a good way to start, but it happens. Your first payment comes in late. So to bring this loan current, you'd have to pay the $1,100 for the payment plus a late fee of about $55. The late fee slows down the reduction of principal, whereas before, when you paid on time, it reduced the principal by about $114. The addition of the late fee only reduces it by $59.29, which gets the bank more interest because anything that slows your principal down enables the bank to compound more interest or more principal longer. Okay, so now let's take the situation in which you miss a month's payment and decide you're going to bring the loan current the following month. For that, you'd need 2 payments, in this case of $1,100, plus the late fee. That's about $2,256 right there. And out of that, they're going to take the late fee first, then they're going to take the interest for the original payment, the one you missed, then they're going to take the interest for the current month's payment, and then whatever's left they subtract from principal. When the dust clears with the numbers, it turns out that your new balance is $1,756 higher than it was before you missed the payment. What kills you here is compounding. From the compounding on just 2 missed payments, you've increased your balance by $1,756, and that's not the way you want your balance to go. You want it to go down. The first payment example we're using here admittedly is the worst case scenario, but the effect is always the same no matter when it happens in the loan. Number 7, payment plans for missed payments. This is a favorite of banks for making use of compound interest against you in a big way. Most people cannot afford to pay twice their monthly payment plus the fees, as we just went over in the last example, when they want to bring their accounts current. So the bank will do a payment plan to allow you to spread the missed payment over multiple billing periods, usually 2 or 3. The thing about these plans is that the bank decides how the money gets allocated between fees, principal, and interest. So your payment for the next 3 months is going to be a third higher. In this case, it would be $1,889, and that includes the fees. Thanks to compounding, your new balance is going to be $152,034, so it's going to go up $2,034. From that, they subtract this increased payment. That gives you a balance in excess of $150,000 that the bank gets to compound interest on for 2 more months. And since part of your missed payment has not been paid, it may still be considered late. If the lender does this, you'll still owe 2 more late fees until you get the thing paid off. So if you've ever missed a payment and been surprised at how understanding the bank seemed about it, you now know why they're so understanding and exactly what it is they understand. Number 8, prepayment penalties. Yes, paying off a loan too fast can cost you. Suppose that rather than missing a payment, you went the other way. You had a promotion and you got your income went up. You got an inheritance, or you won the lotto, or you won big in Vegas, and decided to pay off a big chunk of your debts. Very sensible decision, by the way. Well, not to the bank. You're denying them a whole chunk of interest that they were expecting to get by you paying that loan off slower. So the banks are going to say, not so fast, but they're going to do it in the form of a penalty fee for paying early. It's called prepayment penalty. In the U.S., student loans and FHA loans are not allowed to use prepayment penalties. Read the fine print for any other kind of loan. Prepayment penalties usually are used with mortgages, but any loan can have one, and you should walk away. If you haven't gotten into the loan yet, you're still negotiating, you should walk away from any lender that charges one before ever signing that loan. If you have one of these things that has a prepayment penalty, call the lender, read anything they gave you labeled addendum. It'll usually be listed on something called the addendum to the note. If you can't find it, call the lender and find out the following 3 things at least. When the prepayment penalty is triggered, when they apply. Do they apply to partial payments? Do they apply only if you pay the loan off in full? Do they apply if you pay in excess of a certain percentage of the remaining balance? Find out if there's a trigger threshold like that, how much you can pay extra without triggering the prepayment penalty, and then also find out how the thing is calculated. There's a few different ways the banks like to do it. Anytime you get a payoff number on a loan with a prepayment penalty, make sure that payoff number includes the prepayment penalty. Number 9. Negative amortization, also known as interest capitalization. This one to me is right up there in the sleazometer with the prepayment penalties. Works like this. Anytime a lender allows you to make a payment less than the monthly interest cost so that A, no principal gets paid off, and B, interest gets compounded against you and makes your balance go up, that's negative amortization. I'm referring here to things like student loans and credit card lenders telling you you can skip a payment. With student loans, you get the loan, go to school, and you don't have to start making payments until you graduate, but the interest is accumulating on the principal the entire time you're in school. The other common way you'll see this is a workaround to a 2003 law that requires credit card lenders to set minimum payments high enough to pay some principal. This is in the U.S. That law, however, does not stop them from letting you skip payments entirely, which accomplishes much the same thing. If you get an email from your credit card lender saying you don't need to make a payment that month, that just lets interest compound 1 month against you with no payment from you, make a double payment if you can, and take it as a good sign. It lets you know you're getting to them. Mortgage lenders are not prohibited from allowing minimum payments that increase a loan balance. Never ever take this option if it's offered. Always pay extra principal. Those are 9 common ways that banks use compounding against us all. The rest of this series will be ways we can all fight back. There's going to be a link on the screen and in the description to the Tradecraft Solutions playlist if you want to learn more about the debt reduction strategies that I've used in my quest for financial independence, starting with a very low income. Take a look at those, and we'll see you in the next video.